Welcome to Wealth and Wisdom, the place where we break down the world of finance and investing so you can make smarter, more informed decisions with your money. Whether you're new to investing or just looking to refine your strategy, today we're diving into the basics of how to start investing and how you can take those first steps toward building your wealth. Let's get started. Before we jump into the how, let's first talk about the what. So, what exactly is investing? Simply put, investing means putting your money into something with the goal of growing it over time. The idea is to earn a return, whether it's through interest, dividends, or price appreciation, meaning the value of what you invested increases. While saving is great for building a cushion, investing helps you build wealth over time. Unlike saving, where your money just sits in an account and earns minimal interest, investing offers the potential for higher returns, but it also comes with risks. Now you might be wondering, why should I start investing? Well, the simple truth is, money loses value over time due to inflation. If you leave your money in a savings account, it won't grow as fast as the cost of living increases. Investing helps you stay ahead of inflation and build a solid financial future. Another reason is compound interest. When you invest, your money can earn money on itself. This snowball effect allows your investments to grow exponentially over time, which is why starting early is key. So, how do you actually invest? Well, there are several different types of investments, and it's important to understand them before diving in. Let's go over a few. Stocks. When you buy a stock, you're purchasing a small ownership stake in a company. If the company performs well, your stock can increase in value. Stocks offer high potential returns but also come with higher risk. Bonds are essentially loans you give to companies or governments. In return, they pay you interest over time. Bonds are considered safer than stocks but typically offer lower returns. Mutual funds are a collection of stocks, bonds, or other assets managed by a professional. They allow you to diversify your investment without having to pick individual stocks. This helps reduce risk. ETFs, or exchange-traded funds, are similar to mutual funds, but they trade on the stock exchange like individual stocks. They often have lower fees and provide instant diversification. Investing in property can be another way to build wealth, either through rental income or appreciation in property value. First, set your financial goals. Ask yourself, what do I want to achieve with my investments? Are you saving for retirement, a home, or just looking to grow your wealth? Understanding your goals will help you determine the right investment strategy for you. Next, build an emergency fund. Before investing, it's important to have a financial cushion in case of unexpected expenses. Aim to have at least 3 to 6 months of living expenses saved up in a liquid account, like a high-yield savings account. Now, you're ready to open an investment account. If you're just starting, a brokerage account is the way to go. There are many online brokers that allow you to start with as little as $1, and some even offer commission-free trades. Look for platforms that are user-friendly and have low fees. Once your account is open, choose your investments. As a beginner, it's wise to start with more diversified investments, like index funds or ETFs. These spread your money across a range of companies, reducing the risk of putting all your money into one stock. Let's talk about risk, because no conversation about investing is complete without it. Every investment carries some level of risk, whether it's the risk of losing money or the risk of your investment not performing as well as expected. That's why it's so important to understand your risk tolerance. Risk tolerance is how comfortable you are with the possibility of losing money in the short term in exchange for the potential for higher long-term returns. Generally, the longer your investment horizon, meaning the time before you need the money, the more risk you can afford to take. But if you need the money sooner, you'll want to go for safer investments. Also, remember that diversification is key. Don't put all your eggs in one basket. By spreading your investments across different asset classes, you can protect yourself against the volatility of any one particular investment. One of the most important things to keep in mind as you start investing is that you don't have to be rich to start. In fact, you can begin with as little as $10 or $50. What matters most is consistency. The earlier you start, the more time your investments have to grow, so make regular contributions to your investment account, even if they're small. Remember, investing is a marathon, not a sprint. You won't get rich overnight, but with patience, time, and discipline, you'll be on your way to building a secure financial future. So there you have it. Starting to invest isn't as complicated as it may seem. It all begins with setting your goals, building a strong foundation, and choosing the right investment options for you. The key is to start, no matter how small, and stay consistent. Thanks for tuning in to Wealth and Wisdom. Don't forget to like, subscribe, and click the bell icon so you never miss an update. If you have any questions, drop them in the comments below. I'll be happy to answer. See you next time, and happy investing.